G'day guys, Rich here. Today we're going to move on and talk about stage 3 of our diversified systematic trend following workflow processes. So stage 3 we'll be discussing trading a principle rather than the market condition itself. And to understand that, we need to step through this video. So let's get cracking. So we've already had video 1 of this multi-part series, which looked at the core design principles that need to be embedded in every price following system that ultimately ends up in a diversified systematic trend following portfolio. And those principles are: it must have an initial stop, a trailing stop, no profit target, an entry filter, and a breakout entry design. And then we started to look at a Donchian breakout system that was configured with those core design features to assess whether it might possibly be a suitable system candidate for a diverse trend following portfolio. And then we had video 2, where Fred showcased how, following the design logic phase, we then code up our system to allow for systematic application. Now, it's essential when adopting a rules-based approach using a large composite of trading systems with specific rules embedded in them that we systemize the process. We eliminate as much discretion in our trade application as possible to prevent our brains attempting to override or second-guess this rules-based process. Now, how we test these assumptions embedded in our rules-based approach is through extensive data analysis. We use empiricism as a method to hone in on our system solutions and also as a basis to validate any assumptions embedded in the design process itself. We do not trust in our biased brains or gut intuition. The long-term data set does not contain emotions, just fact about how the system has performed over a very long data horizon, comprising a multitude of various market conditions. And embedded in the backtest is an imprint of how robust the system is. So a rules-based systematic approach is the only way forward for a price follower who avoids any form of prediction. Price itself, and of the price of the past, holds all the necessary information we need to apply in our system processes. The success of the price following solution lies in extensive diversification across markets, systems, and timeframes. So if you are not systematic in your application, then there is simply no way that you can manage such a large bundle of trading systems through discretion alone. So you must be fully automated if you want to play this game. Any form of discretion is considered a bad word in the price following approach, as you have already developed your rules-based approach using your core design principles, and these are embedded in these automated systems. Discretion actually compromises the design core logic and compromises your rules-based approach. So what we have done so far is to adopt a broad common design logic to all systems of the portfolio and have developed an algorithm that we'll be using for extensive data analysis and testing to take us further towards our quest for a powerful and diverse, robust portfolio. You can see that the systems we consider are very simple in overall design. For example, the Donchian breakout system that we've already discussed and are currently investigating couldn't be much simpler. While they may not hold any appeal for a retail trader looking for a single solution to earn their instant fortune, it is exactly this type of simple solution that we as a diversified systematic price follower love. However, we have just started the design process and there's a lot more to do before we accept a suitable design with multi-market potential. The term simple is more like how the physicists use the term. Simplicity is a solution that captures a fundamental principle of how the way markets behave. While we acknowledge how physicists use the term simple, we can hardly call the equations that follow from their simple ideas simple. In the same way, our system designs are simple or parsimonious in nature. Simplicity to us means very efficient in terms of capturing the market behaviour in the most effective way possible. You see, design simplicity actually allows for multi-market potential and a robust all-purpose trader. Design complexity, however, on the other hand, leads to either a solution for a particular market condition with a finite shelf life, or worse still, a curve-fit result with no shelf life. Your system design comprises constraints that dictate terms to the market. Poor designs unnecessarily introduce drawdowns into your long-term result. So simple quality designs float with the market condition. You need to reverse your mindset and think in terms of the simple designs with few constraints that allow the market to dictate terms for the trader. After all, it's the market that should decide your fate, not the apparent cleverness of your system design. So each design variable in your system acts as the snags that can potentially throw you out of a trending condition. We all know that major trends that we refer to as outliers come in a vast array of different types and trajectories. So a simple design with fewer design variables allow you to capture a broad range of different types as opposed to a single specific type. Now, as opposed to predictive trading methods such as mean reverting methods that seek the edge made available through the propensity of markets to exhibit predictive oscillatory behaviour from time to time, in hunting the right tail of the market distribution of returns, we are seeking a market principle as opposed to a predictive market condition. To capitalise on a market principle, you need a simple design statement. A complex design statement is best applied to a specific market condition or a predictive trading approach, capitalising on a specific market behaviour. Now, any liquid market, being a complex dynamic system, oscillates in nature. Its kurtosis can wobble and its skewness can wobble over time. Sometimes the distribution of market returns during efficient market conditions displays no clear arbitrage opportunity. And the mesokurtic distribution, or the normal distribution, displays this signature. And under these particular market conditions, the distribution of returns follows a normal distribution. This means that in a normal efficient market exhibiting no arbitrage opportunity, random luck alone decides your fate. So an unlucky trader under these conditions would have a trade frequency graph that sat towards the left-hand side of the distribution curve. A lucky trader who trades a normal distribution of returns will plot their distribution of trade returns towards the right-hand side of the normal distribution in terms of their trade frequency results. Now, when markets become more predictable in nature during, say, mean reverting conditions, where market behaviour oscillates around an effective stationary equilibrium point, then there is an arbitrage opportunity for the trader who likes to think with a predictive mindset. And this predictive opportunity lies in the peak of the curve above the normal distribution. This is described by the leptokurtic distribution curve, and a successful mean reverting trader during these predictable phases of a market condition would find their edge being derived from the peak distribution of returns in this zone here. The problem, however, is that this peak is finite and ephemeral in nature. It is bounded. We can see the area underneath this curve sitting above the normal distribution is finite and it's fleeting. There is also a wobble in the overall skewness over time and kurtosis, where the peak wobbles around its central tendency, resulting from different predictable conditions associated with different market equilibrium points. So this wobble results in the finite ephemeral nature of the predictive market condition, Sometimes, during a particular market condition, it oscillates around a known equilibrium point. At a later point in time, it might oscillate around another equilibrium point. This disparity between equilibrium points and predictive oscillation results in a wobbling in the peak of the curve. And this is what creates the finite ephemeral nature of the predictive trader who successfully tries to exploit arbitrage from the peak of the curve. Now, while markets remain predictable, these traders have very high win rates but low reward to risk ratios. They also tend to possess negative skew signatures as they are less focused towards cutting losses short at all times. But on the other hand, sometimes the markets become very unpredictable in nature when the market distribution of returns has negative kurtosis and displays fat tails. This is described by the platykurtic distribution curve, and it is a right-hand tail of positive outliers which feeds the price follower. They deliberately configure their systems to cut losses short at all times so they do not wander too far towards the left-hand tail and focus all their attention on this right-hand tail. Now, where the true edge lies for the price follower and the reason for their amazing long-term track record is due to the open-ended nature in the potential tails themselves. Now, trends can occur in any of these general market conditions. However, the specific trends we are after relate to those that give rise to that right tail. So now that we understand where the bias exists or the arbitrage opportunity exists for the predictive trader versus the price following trader, in hunting the right tail of the market distribution of returns, we are seeking a market principle as opposed to a predictive market condition. And that principle is that if you trade in the zone of the fat tail, then the trends you trade in that zone are more enduring in nature with unbounded infinite potential than other types of trending condition that the market throws at you from time to time. You see, a simple trending price pattern could either be a result of a random series of price movements, and these diagrams on the left, these two on the left, are actually randomly generated, but they look, for all intents and purposes, like definitive trend movements. But this is just to showcase how visually you cannot use any method to define whether these trending conditions are random or not. So we can't detect the visual difference between a random trending price series and a non-random one with autocorrelation present. It is actually only through extensive data analysis that we can come to any form of definitive conclusion as to whether there might be price bias in the data series. Now, this third chart shows a yellow trend, which is a randomly generated trend, and a blue trend, which is that same randomly generated trend with a small bias applied to the price series. So in relation to what we regard as the non-random component of that trend, it actually represents the difference between the random trend and the non-random trend with drift present. So visually, we can't use a method to distinguish between the two, but we can use data as a method to define whether there is a bias in the overall price series over a long-term data set. And it is through quantitative techniques that price followers need to use, as opposed to visual methods, to assist them in identifying whether their systems actually have a definitive edge from some associated price bias that exists in the data series. And it is only through this data analysis that we can come to any form of definitive conclusion as to whether there may be a price bias in the series. So furthermore, our particular approach is not seeking to catch every trending condition. The assumption underlying our methodology is that price extensions are greater in the non-normal zones of the market. Simply catching every trend based on targeting a particular trending pattern leads to less efficient harvesting of the trending condition, And if you catch trends during the more normal day-to-day market conditions, then the cost of the whipsaws amounting from either mean reverting false breakouts or just general noisy market conditions of an efficient market detrimentally affects your P&L over the long term. So our theory is grounded by the assumption that there are better times to catch a trending condition than others. And that's when market transition or trends are significant in nature or outliers. During these particular more exotic periods, markets are less efficient and overall price bias is, with the law of large numbers, more defined and more likely to be more enduring in nature. And the principle we are therefore searching for is based on a feature of liquid markets that has been enduring in nature over at least 200 years, according to a plethora of valid research undertakings by the academic community and the professional fund managers. The principle is this, that all liquid tradable markets exhibit at times fat-tailed behaviour. And these behaviours are unpredictable and relate to dynamic complex systems such as the financial markets, but actually all complex systems, when these systems decide to transition from past periods of equilibrium towards new periods of equilibrium. And these market transitions are unpredictable in nature, but applicable to any liquid market. So, given that we are trading a principle as opposed to simply a trending condition, then our strategies must by definition have multi-market potential. Trend patterns exist at every time scale and may be a random feature of price action, a particular predictive market behaviour such as a swing move in a mean reverting condition, or a feature associated with major market transitions when participant behaviour becomes more coordinated and trends become more enduring and significant to the P&L. We are after this latter condition, and every liquid market has these from time to time. So the reason we specifically hunt for the outlier and avoid trading any trend of possible random or non-random substance is that it is the outlier which is the dominant contributor to your overall P&L. The rest of the trade activity can effectively be summed up as random outcomes of positive or negative outcome. But because we always cut losses short, we never have significant negative outlier events. If you look at the monthly returns of the best fund managers in the world, the diversified systematic trend following community, you see that the outliers dominate the overall P&L result. And we see some outliers in this table of monthly returns highlighted in blue, resulting in these overall outlier impacts at the annual level. If you interview the most successful traders and investors on this planet, then they all owe their fortunes to the unpredictable outlier event. While luck may have a say in their total fortunes, the subtle nuance of this luck is that to participate in these unpredictable windfalls, you need to be in the right time and the right place. Being in the right time for an unpredictable outlier means you need to have your systems turned on 24/7, but protect capital at all times. And being in the right place for an unpredictable event means you need to be very widely diversified across markets, systems, and timeframes. So that probably is enough of the theoretical background that is necessary to understand what we'll be going to do next. In our next video, we're going to turn to the optimization process again to allow the data to speak for itself in testing our assumptions and hopefully find a diversified multi-market solution from this simple system idea of a Donchian breakout technique that can stand the test of time. The approach we take to optimization is fairly unique in that we do not use it as a basis for selecting the single best outcome, which can lead to curve fit results. But rather we use optimization as a basis to validate our assumptions and provide a broad range of suitable solutions that all have multi-market potential. All the theory and background is done now, and this is when we decide to let the data speak for itself and avoid any forms of subjective judgment. This is where the price follower starts to validate their models to the reality of the market. If our assumptions are correct, we will see these assumptions confirmed through the empirical method. So stay tuned to our next video on the optimization phase of modelling and become a member if you want to work with us directly in this exciting project. Cheers, guys.